Good morning, good afternoon, or good evening, depending where you are on the planet. And welcome to the TGI Friday. Thank God it's Friday, Bull versus Bear webinar. Steve Miley here on the Call for Trading. Welcome, everyone. Just to confirm, you can see me and hear me, correct? We've had some updates in here on our streaming platform in here. I just want to double check that it's all working okay. So can I get a yes in the chat, please? If you can hear me and you can, well, you can't see me, you can see the screen. Let's get confirmation on that, please, from someone. If you type in, just give me a yes, and then I know that we're okay. So we're going to go through our usual regular run through in here today. We're going to take a look at the calendar, what we've had, what we've got coming up. We'll take a look at the macroeconomic, fundamental, geopolitical events that are shaping markets right here, right now. And we'll take a look at some of the charts. Okay, all good. I see from Jim, Rob, Ben. Thank you, guys. You're hearing me and seeing everything. All good. So, let's take a look at what we've had, what we've got coming up. Well, what we've had is very little, just some European data, like European data this morning. What we've got coming up is obviously the US employment report. You can see it in here at the top of these on the in the whole of the members area. No trading 2 minutes before or after US employment data released at 7:30 Central Time today. So in just under 1 hour, we have that data coming up. Obviously, it's a big important piece of data. From my perspective, it's been the most important piece of data since I started working in financial markets over 30 years ago. God, way over 30 years ago now. And it was the biggest piece of data then, and it still is today, really. I mean, inflation data has been more important more recently over the last few years, but less important right now. So it is still a very much watched piece of data to give us an idea of where we are with respect to the strength of the US economy and the labour market. So we're definitely going to be watching out for that. Remember, it's not just that headline data in here, which is what we see as the non-farm payroll number. So where we've got that coming in, 164,000 expected. It's not just with the payroll number, it's also the unemployment rate expected at 4.2%, but it's also average hourly earnings. Are there inflationary pressures coming back through in here? So we're watching out for that. 0.3% month to month expected on the average hourly earnings. So it's all of that. And it's not just all of that, but it's also watching out for revisions. We often get revisions on the non-farm payroll number. So the previous was 227. What does the revisions mean? If you don't know, just a little bit of teaching in here. Let's say we're expecting here 164,000. If we get a beat on that, if it's better than expected, let's say just for ease, it's 30,000 higher than this number. But the revision on the previous one is 50,000 lower. Then net from where we expected it to be, we're actually lower, not better than expected. So if the number was higher than expected initially, 30,000, but the revision is bigger than the actual how much the number is higher than expected, then net, then that's actually worse than expected. Okay, so we do have to take the revisions into anticipation. And that's why you see a lot of choppiness over the data, and that's one of the reasons we have for no trading 2 minutes before or after data, because of that volatility that we get in the market. And the potential to lose a lot on slippage in the real live markets, which you don't get so much on the simulation markets, the evaluation stage, and if you're in the sim market. But if you're in the live market, slippage is a real big thing. Slippage is when you maybe put a stop at somewhere, and then where you get filled on that stop could be a long way away from that, which doesn't occur so much in the simulation market. The simulation market is a simulation. It's not a perfect replica of the live market. In price it is, but not necessarily in volume and how volume reacts. So just keep that in mind. That's one of the reasons we have that, but obviously key focus today is on that data. We also don't forget sometimes it's in the shadow of the employment data, the Michigan consumer expectations and sentiment data. Watching out for that. We get that a little later at 10 o'clock Eastern. It's not going to move the market too much after the employment data potentially, but nevertheless it does move the market sometimes. So watching out for that Michigan consumer sentiment data as well. In here, running through now onto the this is basically what has replaced 5 things to start your day. The Bloomberg used to publish now the morning briefings, America's version in here. A lot of focus on the LA fires in here. Obviously a big negative for the economy, but not really impacting directly onto the financial markets. You guys are mostly trading onto the bond markets, onto the equity indices. Nevertheless, tragic, but nothing really impacted us. Donald Trump's last speech to halt his sentencing in the hush money criminal case rejected by the Supreme Court. Again, not massively impacting onto us. The main thing we're focusing on is this job data, as we've already gone through. Wall Street thinks a too hot or too cold report may lead to a 1% drop in the S&P 500. So what we're looking is for the market to be just about right. That's the thing in here at the moment. If the economy looks like it's slowing, if the number is below expectations, so we're looking for 160. Well, they've got 165, so it's around 164. 164 was on here, right? 164, 165. Mid 160s in here is what we're looking for. If we see that number lower than expected, and so fewer jobs added, then that shows the economy is slowing and the market's going to worry about that. So equities could go lower. If the number is significantly higher, okay, what that would potentially mean is if the number is strong and shows a strong labour market, a strong economy, then the market could look at that easily and just say, well, that means the Fed has got no reason to be aggressive with any rate cuts this year. We're only expecting 2 more rate cuts this year at the moment, okay? Or not 2 more, 2 rate cuts. Not 2 more. We haven't had any this year. So we're only expecting 2 rate cuts at the moment this year. The Fed, if the number's strong, the Fed may say, well, we only need 1, or maybe we don't need any rate cuts this year. And if there's that, and if that's the case, then the market will look at that as a negative as well, because the market wants rate cuts, okay? It's positive for the economy. It stimulates the economy. It's positive overall for stocks as well, usually. So we want to be able to see a more dovish Fed. So what we really want is not too hot, not too cold, just about right. It's the Goldilocks scenario, okay? The Goldilocks scenario, not too hot, not too cold, just about right. And so we want a number around that figure. Potentially what we're probably looking for is anything maybe just slightly better will probably be okay. Even slightly worse will be okay in here, because if it's a slightly worse number would then increase the likelihood of a more dovish Fed. But what we don't want is too hot, too cold in here. And if I just click through on this link, we'll have a little look. Well, do they actually give us a scenario analysis on? So this is from Goldman. Look, Goldman, Bank of America, Walmart stocks could slump if payroll surprises. So we don't want a surprise either way. I don't know if they give a scenario. Oh, yeah, here we go. Here's a scenario analysis in here. Who is this from? This is from Goldman. So greater than 200,000, at least 1% down in here. So these are Goldman numbers. These are JP Morgan's numbers. 220 between 0.5% and 1% down. So here's the just about right scenarios in here. And then if it's too big, look, we're going to see the market down in here if the numbers disappoints. If anything you can see in here on this skew is the skew, particularly from the Goldman side, is they're looking for it to be, if the numbers softer than expected, so lower than expected, they're looking for the market to actually go up. And it's only if it's significantly lower than expected, then it goes down. Where JP Morgan are actually saying, well, if the number is slightly lower, it's going to go down, okay? And so they're a little bit more cautious, but a little bit more pessimistic in here on the numbers in here. So have a look at that one there. I'm going to share this link in here. Okay, if you can get that on Bloomberg, yeah. If not, I don't know what else. You can have a quick look, take a snapshot right now, maybe of this here, so you can see a bit of a scenario analysis of where both Goldman and JP Morgan are looking for it to move, depending on where we go on the jobs data. Okay, so maybe take a snapshot of that if you want. Okay, I'll just leave that there for a little second. If you want to grab a snapshot. So what else do we have for you? That's just the homepage. Stocks forwards traded. So stocks, obviously we were closed yesterday. On the overnights in here, slightly lower, dipping lower. US actually futures lower. European stocks kind of mixed in here this morning. So markets just wait and see mode, having sold off back on Wednesday. US December jobs report expected to show healthy labour market. So again, 165,000 is the expectation. A little blip on the horizon. Chinese stocks head for a bear market. So China is continued to be in a negative mode in here at the moment on the stock indices. And that's not good for the global markets in here. You know, China is one of the powerhouses of manufacturing on the planet. And if we're seeing China going into a more negative theme, and it has been negative in here for the last year, really, underperforming global indices, then that's not good for the global economy, not a good reflection of the global economy. And just running through the similar kind of headlines on Reuters, bonds simmer as payrolls off a reality check. Stocks wobble ahead of US jobs report, bonds in the spotlight. So bonds continue to go to higher yields in here, and that's a real concern as we go into the early part of 2025. Higher yields in here, potentially weighing on any potential gains for equity markets. A very, very, very quick look into next week in here before we do the wrap on where things are on the overnights. So next week we get earnings season kicking in. I've been mentioning this. Next week on Wednesday, January the 5th, we get JP Morgan, Wells Fargo, Goldman Sachs, and Citi. Actually, today you can see we've already had some significant companies reporting. We've had Walgreens, Delta, and Constellation brands in here, all reporting here, mostly green, but Constellation in here slightly negative in here this morning. But we've got the really kick off in earnest next week on Wednesday. And then also next week, looking at this little week ahead in here, inflation report. We get the CPI report next week. That's also on January the 15th. Okay, so on next Wednesday, we get earnings season kick it in with the financials of those banks. And then we also get the CPI data. So a busy day next Wednesday, a lot to focus on going into next week. On the overnight run through in here, as you see, the Nikkei and the Hang Seng down around 1% for both of them this morning. European stocks are mixed, with the FTSE down about 1/3, the UK FTSE, the German DAX up about 1/3, and a similar for the 1/4%, just over 1/4% for the French CAC. And the US futures in here this morning slightly lower, so 1/3% lower on the Nasdaq and about 1/4% down on the S&P 500. On the FedWatch tool, looking at the meeting at the end of January, this has been pretty much unchanged. It's been sitting above 90% for all of this year, and it's from the end of last year. If anything, is slowly creeping up. So real no chance. This is unchanged. 425 to 450 rates. That's where the current target rate is anyway. So 93% chance we're unchanged at the meeting that we get at the end of January. And here you can see bond yields ticking up. They've been ticking up since the beginning of the year. I'm kind of sideways in here, but sideways at the very top of the recent move. And you can see in here on the multi-month, we're sitting right just below this multi-month high in here. This is all going back all the way to where are we in here? That's April 2024. Okay, so April 2024, and we're just below that high yield on the 10-year, which comes in at 4.74. A break above there will then put us at the highest point since we've been at since October 2023, and then we're heading up to this level up here, just below 5%. We just failed at 5%. So 475 kind of area, an important level to break above potentially. On 474, 475 on 10-year bond yields. So we'll certainly be keeping an eye on that. Above there will definitely open up risk for higher yields, and then higher yields equals potentially putting a cap, particularly on growth stocks and the Nasdaq, which is, market's struggling to break to the upside in here so far this year. If we do look at the US fixed income right across the board, near 30-year, 10 years, all looking pretty negative in here. Not so much in the belly and the short end of the curve. 5-year and 2-year, not quite so negative. So remember, the 5-year and 10-year, more a reflection of the central bank, okay, where we look at the 10 and 30-year, that's a reflection of the economy. So this is concerns about reflationary pressures resurfacing, potentially because of the Trump agenda. Okay, so this is what this is looking at in here. This is why bonds are going to lower prices, higher yields. Concerns about the economy, concerns about maybe a resurgence of inflation. And if you go look at the equity indices, having had a solid rebound in here out of support for the S&P 500, we switched bullish in here a few days ago, Monday, Tuesday, I think, we switched to more bullish in here with this rebound that we saw. Market drifting off back on Wednesday and obviously closed yesterday and sort of just marking time yesterday. So real risk in here of us breaking down again. So we could see this turning to a topping. So look, struggles to main bid, but retaining longs for now just. So we're just hanging on. Look, with phase recovery, but retaining longs for now just. So we're just hanging on to a more bullish tone. Check out the levels in there on the data. You can get those reports, remember, below where you are watching this right now in the members area. And if I look at the bond market, on the equities in here, we've got on the daily here on the ES, you can see we've held above this 59.15 to 59.10 area. We've had a couple of brief spurts down below there. You see this level over here. So between 59.20 and 59.10, the market seems to be holding that support. We did that spike below there and rebounded. So that's going to be kind of a critical area. We've sort of held there back a couple of days ago on Wednesday. We held there on the very small amount of time we were open yesterday, and we've held there and rebounded this morning. But I think if we take out 59.20, 59.10, then the market could easily be back down to these spike lows down at 58.70 to 60 kind of area. So watching out for that on the downside. If you zoom into the 30-minute chart, you can see we did reverse earlier this week above this kind of counter down trend line. So that comes up, that's this trend line here that comes down through here. So we did manage to spike above that and get above that trend line, and then failed back lower, broke down the uptrend line, this uptrend line here. And now I think this is the trend line that's in focus now. So on the upside, if we can get above on the S&P 59, 59, 80, 85, then it starts to look more bullish in here. So watching out for that post the data. It's obviously all going to be on that data today. Similar story in the NASDAQ in here. So it's gone down. It's kind of held this area here. It's held between 20, like really 21, 150 kind of area. On a number of occasions, 21, 150. If it gets below there, then I think it's back down here to like 29.75 and maybe lower. So watching out for that on the downside. On the top side, we've got the similar. We've broken above this. First of all, this counter trend line. Then we broke down through the uptrend line. And now we're looking at this counter trend line here. So back above really. For me, on the top side, you're looking at 21, 530, 550 kind of area. Needs to get back above there to resurrect the more bullish tone. If it starts to break below those supports I just mentioned, then it looks a lot more negative. All right, guys, I'm going to leave that with you today. I'm going to wish you all a great trading day. Watch out for that payroll data. We've got it now in about 45, just under 45 minutes. Remember, no trading 2 minutes before or after that data. No trading 2 minutes before or after the US employment report, 7:30 Central Time in about 45 minutes. I say I'm going to wish you all a great trading day. Take care, stay safe, have a great weekend, and we'll be back with you on Monday for another Bull versus Bear webinar. Bye.